Okay, so first thing I want to discuss, I've been getting a lot of requests for with the upcoming IPO of Facebook, which is scheduled to start trading on Friday, is some potential option strategies to capture what is, going to be expected upside momentum for Facebook. So Facebook's IPO is priced between 34 and 38. People, including myself, are expecting there to be a lot of momentum that first day. But options on Facebook aren't going to start trading until about another couple weeks at least. So wanted to touch on some other ways to actually take advantage of Facebook and the momentum behind it for that day. The first and safest one, in my opinion, would be QQQ, the ETF that tracks the NASDAQ. The other nice thing about QQQ when it comes to options is there is a lot of liquidity. You can see that the in-the-money strikes on QQQ, on puts and calls, I mean, look at this. We had 155,000 contracts trade on the puts. So, tons of liquidity, 48,000. Now, so overall, if you're bullish on the effect that Facebook is going to have, okay, you could say, all right, Facebook's IPOing this Friday. I expect there to be a nice solid boost in QQQ as a result of it the day up. Now, what's tricky is you don't know when the Facebook effect is going to come into play, and you don't know how long it's going to last. So on something like QQQ, for instance, you have options expiring this Friday, and the ones that expire next week won't be trading until Thursday. So there's a couple things you're risking here. If you wait until Thursday to buy the QQQ options expiring Friday, you're only giving yourself one day. Okay, so that's the risk. You're only giving yourself one day for the move to happen. And in prior videos, we've talked about the effect that time can have on premium and whatnot. Now, the other side of that is just like you see stocks like Apple run up ahead of earnings or Google and stuff like that, I believe there's definitely a possibility that you'll see QQQ start to move higher, maybe starting tomorrow or Thursday, in anticipation of Facebook's IPO. So some of you might want to buy QQQ call options tomorrow thinking that you're going to get a run up on Thursday ahead of the Facebook IPO. Now, personally, I would rather have my trading be based on the charts, regardless of any IPO. So based on that, on QQQ, on this 5-minute chart, so it fell below its lows from yesterday. So I'd like to see it get back above this 63.50 to 63.60 level. You can see after hours it's down here at 63.46. If it can do that tomorrow, that could be a signal to get long. Okay? Now, the other strategy you might want to say is that Facebook is going to save the tech sector, for instance. Okay, so what do I mean by that? I blogged about it today in my post, or maybe it's going to be on my post for the morning. So technology, as represented by QQQ, has been on a very, very nice run from 2012. So closed 2011 at 55, got up as high as near 70 in March. Okay, if Facebook would have been IPOing in late March, early April, you could have said Facebook is going to be the catalyst that pushes QQQ past 70. Okay, however, now over the last month and a half, QQQ is actually in a downtrend. So now Facebook goes from being the potential catalyst to pushing it past 70, where now Facebook needs to be the potential savior in keeping QQQ above its March and February lows. Now, myself personally, I liked Facebook to be the catalyst to push it over 70 a lot more than I liked it to be the savior that keeps it from moving lower. Okay? I just don't know if I want to put that much responsibility on Facebook, especially when stocks like Apple have broken their trends. Priceline has broken its trend. Okay? Salesforce has broken its trend. So you have your high-flying tech names have really broken down some. Even Microsoft, which had been pretty strong, has started to downtrend. And the reason I'm pointing this out is because some of you might be thinking, oh, well, I don't want to risk going so close to expiration, so I'm going to buy the June put. I'm going to buy the June calls or the July calls, okay? And what you need to understand there is just what I'm talking about. How much confidence do you have in Facebook versus we know to expect there to be momentum on Friday. That's obvious. That's the day of the IPO. But is that momentum going to last a couple days, a couple weeks, a couple months? You know, how long is that momentum going to last in the face of a market that has suddenly gone from being very strong and in an uptrend to now it's in a downtrend in the short term, okay? So these are the types of factors you need to consider. Now, the play I happen to like the most is shorting Facebook stocks that have been weak. What do I mean by that? Facebook stocks, I group all these recent internet IPO stocks into one group. LinkedIn, okay, Pandora, Groupon, Zynga. These are all the same sector to me based on the fact that they're all social media, you know, internet type. So what I like to do the most is I see a chart like Zynga and Pandora, and I see two charts that look like absolute pieces of shit. Since their IPOs, these things have done nothing but lose investors' money and traders, unless you've been shorting them. However, now what you've noticed this past week, in anticipation of the IPO, Zynga from 734 up to, what, 867? So that's a 17% bounce in 2 days. Pandora from $9 up to $10.90. So that's a 20% bounce in 2 days. What is going to happen to these stocks once Facebook starts trading? This to me is a perfect setup to get short on names like Zynga and Pandora. You want to play them from the long side leading up to the IPO, but once the IPO happens, I would expect these names to resume their downtrends. This is just nothing but a short-term bounce up, in my opinion. Pandora really needs to get above this 1175 level before it can really say it's broken out of any trend. Zynga has a long way to go, needs to get above this $10 to $11 range. So these are two stocks I like from the short side. So on Zynga, for instance, you could buy the, let's see, the $11 put for $2.70, putting your break even at $8.30, expiring in June. So that's 30 cents below the current price. You're only paying a 3.5% premium on that. Pandora, okay, at 1061, you could buy something like the June 15 for $4.50, and you're not paying any premium, really. You're paying less than 0.2%. If you wanted to be more aggressive, you could even buy the $13 strike for $2.75. And let's see, you're still not paying that much in premium. You'd be paying at $2.25, so you'd be paying 40 cents. So you'd be paying about 3.7% in premium. Now, why is my opinion that these stocks are going to downtrend after Facebook versus the argument that, oh, Facebook's going to IPO, the valuation is going to be ridiculous, and as a result, it's going to make valuations on stocks like Zynga, Pandora, and Groupon look cheap. How come I'm not arguing that fact? Well, people who have attended our classroom sessions before and understand my reasoning on how hedge funds buy and sell stocks, maybe somebody has a reason of their own as to why I would expect these stocks to resume downtrends. if anybody wants to give their own reason as to why I might be thinking that. Remember, think about what we've talked about in the past, how hedge funds buy. Exactly. They buy in the same category, like Jay Kent points out. You know, they buy in the same sector. They're buying the social media internet sector. Right now, that money has been spread around between a couple names: Zynga, Pandora, Groupon, LinkedIn, Zillow, okay? And we're about to add the biggest name of all to that list, okay? So the question is, are these funds who have invested in these stocks, are they going to allocate new money to these stocks? Or are they going to allocate money that's already in the sector to Facebook? Well, let's just think about this logically. Why would you allocate new money to a social media IPO when you've been burned by buying Zynga in the first place? Why would you allocate new money when you've been burned by buying Groupon in the first place? Why would you allocate new money when you were burned by buying Pandora in the first place? The only one you weren't burned on is LinkedIn, okay? So I suspect what's going to happen is they're going to take money out of Zynga and out of Groupon and out of Pandora, and they're going to put it into Facebook, and that's where the money is going to come from. That's why the strategy I like more than anything is shorting the social media names that look weak, which we've pointed out, versus, you know, guessing if QQQ is going to be able to rally. Because these downtrends here in Pandora and Zynga, they take away a lot of the guessing that we'd have to do with a stock like QQQ. So that's just speaking a little bit on the Facebook strategy. Okay, and I'm actually going to go backwards and do charts first because I cannot go past about 7:05, 7:10 tonight, and chart reads will be relevant tonight. Questions are relevant every night. So I'm going to do the charts first. I hope that's okay with people because I can tell you now we're not going to get to all the questions. But they will get answered tomorrow. LinkedIn. First chart. Very nice uptrend. I really like the volume pattern. It's going up on high volume and pulling down on low volume. Okay. What I don't like is its inability to bust out of this range, and it actually gave up all of its gains post-earnings. Some of that might have to do with the fact that maybe they're freeing up money to put into Facebook, but that's neither here nor there. That would just be an assumption, and we don't rely on assumptions when it comes to technical analysis. So this low is the key low overall for this trend, 101.53, and then yesterday's low at 105.50. Okay. So really this range is key. As long as we stay above this range, people are going to expect a retest of the all-time high at 120.63. Okay. You've got resistance at last week's high of 115. So really this is pretty clear cut. Your first key support is yesterday's low, 105.50. Resistance is last week's high of 115. Overall major critical support is this $101.53 post-earnings low. Overall critical resistance is the post-earnings high, 120.63. Doesn't get much more simple than that. I like the increase in volume. We've had, after volume really kind of dropped off, we had our highest volume day on an up day since February. We followed that up with another strong volume day. And then today the volume, while it's lower than the recent volume, today's volume on an up day was greater than any other day in April. So that's good. That tells me demand is returning to this stock and just overall interest is returning to the stock on the long side and the short side. Remember, shorts aren't a bad thing. Shorts can help. Shorts can be catalysts for upside moves if they get squeezed. So if LinkedIn holds support, you know, overall I like this setup because it's offering you a clear-cut risk-reward trade where you know where your stop loss is and you know where your target can be. TRIDQ, nice uptrend recently. It has a Q on it though, so I imagine this is bankrupt. Yes, so overall though, still in a downtrend. You always got to be careful playing these Q stocks. You never know what filing might come out that could disrupt things. Solid volume, you know, not great, but trades 1 million shares a day for the most part. Well, actually yesterday, looks like the average volume is probably around 600,000 shares or so. So you can make some trades in there. Yesterday's low of 441 is key support, and then today's high of 48 is key resistance. Above 48, you'll have psychological at 50. Above 50, now you can see you're dealing with resistance from this prior base. Kind of a wide channel here. We expect there to be supply all throughout this channel because that's where prior support was. So if you do want to bring it down though to maybe this low and then up to these lows, you're looking at between 49 and 54 cents as resistance, and then the excuse me, not 54 cents. These highs are around. Okay, so those are all at 50 cents. So 50 cents is going to be our resistance. Above there, we've got the high of 54 cents from here and 58 cents here. And then, you know, it's just always going to be your previous highs, which would then be 60.54 and then 64 cents. Like I said, support at yesterday's low is pretty key. Below that, it wouldn't surprise me to see this come back down to this 39 to 42 cent range. DGRI went up on high volume relative to average and pulled back on even higher volume, and it's gone up on lower volume, on about the same volume. If you match these 3 days, 107 million, 188 million, so that's about 300 million, 113 million, so about 413 million shares it went down on. Then you had 140 million, 166, and then 85, so about 385 million. So the volume has pretty much washed itself out. So now the key for this is staying above this range, in my opinion. Needs to, if it can stay in the top end of this range, that could really set up a nice move to these previous highs around 0058. So I'd like to see it hold around the 0035 range, give or take a tick or two. And if that can happen and volume picks back up again, then we can target today's high 0049 is going to be resistance, and then this previous high 0058. Certainly one to keep on watch though, because the volume is solid. FFN, another one that's probably getting some love because of Facebook, and another one that I would recommend shorting after the Facebook IPO, because you can see that this trend is just absolutely disgusting. I don't know that I've ever found anybody on Friend Finder. As a matter of fact, I believe the joke is if you're on Friend Finder, you must not have any friends. So this stock just looks disgusting to me, even after today's high volume move. Why? Because last time it did a high volume move from a similar range after a similar downtrend, it gave up all of those gains. So why am I to believe this is anything more than just, you know, a short-term bounce? With that said, this high 137 needs to be taken out. If it can do that, you could check out this high 143, and then this high 149, 150. As for support, yesterday's high 114. Let's see if that becomes support now. Below that, you know, it's just, you'd be talking about the stock giving up all of its gains. So 115 to 120, or 114 to 120, because those are the prior highs. So let's see if they become support. If they don't, like I said, FFN would be giving up all of its gains, and we all know that's just simply not good. Speaking of giving up all of its gains, you guys might remember we talked about Apple last week and talked about why I had a bearish bias on the stock. noting that the volume, I didn't like the severe volume drop-off and the fact that it had given up all of its gains. And you can see, even though volume is still low, a slight increase in supply volume caused a pretty decent down move. You're saying, oh, 0.8%, that's not a decent down move. Well, compared to Apple's ranges over the last week, it actually was the biggest down move it had had in over a week. So something like Apple is an example to cite in terms of why I don't like when stocks give up all of their gains. GWBU closed around 155. E-Trade showing 142 because I believe there was an after-hours trade there. But as you can see from the level 2, we closed around right at 155. This chart is just amazing. You know, doesn't get much more bullish than this. Volume is terrific. Highest volume today of the entire campaign so far, so that's good. It's going to be hard to keep this volume going though, number one. Number two, I just don't like this big wide open gap. However, I want to say I wouldn't worry about it because it's at 155 or whatever, and if it dropped to fill that gap at 110, you'd be talking about a 30% decline. But then I remember that this is supposedly an awesome penny stocks play, and anything is possible. Any type of shakeout is possible, and they could still resume the uptrend no problem. So just be on the lookout for a severe shakeout to maybe fill this gap. Personally, I don't expect it until the run is over, which it will be at a later date. But I'm just saying, don't be surprised. And if it happens in the next couple days, don't get scared to say, oh, it's filling the gap. This is where I actually want to take a position, instead of thinking, oh, this thing's done. It's tanking now. Remember, we saw similar tank jobs on SNPK only to see it recover. Okay, so 5-minute chart shows key support at 146 to, yeah, you had a double low here at 146. So that's our main level to watch tomorrow at the open from the start on any pullbacks. As for resistance, you've got the high of the day at 158. That'll be your key level to watch. If it gaps over 158, let's see if that 155 to 158 range then acts as support. Okay. As for the first 5 minutes, it traded 1.2 million shares within the first 5 minutes of the day, traded 714,000 within the last 5 minutes. Why am I not talking about these trades right here? Anybody care to guess why I'm not mentioning the biggest? Yes, exactly. Just wash trading, and if it wasn't wash trading, it was manipulated one way or the other. We're not believers in that volume. Look, we even have WDCO in chat today to tell us that that was just him wash trading. So that's why I'm not going to give much respect to those volume spikes, because I just don't believe they're that relevant, or let me say this term, I don't believe they're that organic. Whereas the volume within the first 5 minutes and the last 5 minutes, I believe for the most part that's organic volume. So within the first 5 minutes today, I want to see a trade greater than 1.2 million shares. Within the first 15 minutes, as the price is rising, again, that's always the caveat. Within the first 15 minutes, I would like to see it trade greater than 2.5 million shares. Oh no, sorry, greater than 2.75 million shares. From again, that 146 low pops up again on the 15-minute chart. Immediately above that, you've got the 150, just psychologically. Below 146, it wouldn't surprise me to see a realistic dip back down into this range here between 127 on the low side and, 135-ish on the high side. Chart's great. And as for daily volume, remember, we've seen from their previous picks that the price can still increase even though the daily volume isn't as high as it's been at other points in the chart. So what we want to see is we just want to see the price rise on the required volume within that first half hour, and we want to see it hold support and resistance. Why is the stock able to rise on lower volume than those first couple days? Number one, because the majority of the volume is likely wash trading or manipulated. Number two, they have so many noobs and idiots on their email list who hang on their every word that if they say it's going to $5, people are probably going to hold until it gets to $5. And as we know, that's not what we do. So that's why the volume isn't as important on their plays. We allow an exception. When the stock is manipulated, then we can manipulate the rules a little bit, and that's what we're doing here. ORYN, so it held our key support at $1 today. That's the first thing I noticed, so that's definitely going to be key. Overall, this chart's still in play, okay? Why is it in play? Because it's pulled back on very, very, very low volume relative to the volume it went up on from the 7th to the 9th. So I actually wouldn't mind getting long ORYN here between this $1 to $1.10 range and trading against that $1 level. What do I mean when I say trading against? Just another term for, using that level as a stop loss. So as for resistance, it's just basically the 120 level again. The 120 level you saw yesterday, Friday it capped it. Yesterday it moved above it, but then came back down to it. And then today, it wasn't able to sustain above 120. So really let's look and see if we can get multiple closes above 120 to signal a run back toward this previous high of 133 and then 150 above that. Overall, though, this chart isn't telling me that I should take it off my radar. I don't see that yet. What do I like about this? Well, we had this bounce here when it tanked from $1.15 to 90 cents and closed at $1.12. And now we have this bounce when it tanked from $1.20 to $1.10 and to $1 and it closed at $1.10, and it put in a higher low versus this dip last week. So if it can maintain above $1, that could set up a move back to previous highs. JBLU, just ugly chart again. Nothing to like here. Fell below its recent lows. 1 year charts in a downtrend. Overall weekly charts in a downtrend. Just multiple charts on this are in very bad downtrends. Looks like it's going bankrupt. If you wanted my honest opinion, it's in the airline space, which has been a terrible space overall. The other thing I don't like about JetBlue is it's been downtrending while stocks like Spirit Airlines and United Airlines have been uptrending. Let's see on a stock like Delta. So Delta's been uptrending. So Southwest is another one that's been downtrending. So, we always want to be in the stocks that are performing, that are showing strength, and JetBlue just pretty simply isn't. As a matter of fact, I wouldn't be surprised to see this test its November low around 340, so you could maybe even play it from the short side. What's going to keep this 340 target intact is if it stays below what was prior support, which is going to be this 460 to now these lows here, that 460 to 475 range. If it stays below there, then I suspect eventually over the next couple months it'll trade down to this November low. Just nothing to like about this chart unless you're a short. RARS, finally the price action stopped today after the massive dumping the last 3 days. Volume was low though, so there wasn't a lot of interest even after the price action stopped. So, can you see a bounce? Of course. I mean, anytime something drops from 50 cents to 10 cents, it's likely going to have a bounce. But, the whole thing seemed really sketchy on RARS to me. It still seems sketchy. Wouldn't be surprised if they came back and promoted it later on. But the people who were promoting this seem to have moved on from RARs. Just a heads up, I got some emails today from those guys saying that they're going to redeem their list with GWBU and stuff. So just want to be careful, because what might happen is nobody might end up featuring this thing. The volume came from somewhere, though, as you can see. I mean, huge volume out of nowhere. So as for bounce, you've got today's low of 611 to trade against, and really yesterday's low of 7.5. Resistance, today's high of 9.5, and then psychologically at 10. And then Friday's low of 13.3, and then yesterday's high of 16.5. Overall, though, I just think there's better things to make money off of at the moment. Home Depot, a stock that had been in a nice uptrend and kind of fell below its recent lows of the last couple months. Today, on the highest volume that it had seen since September and August, the difference between that high volume when it actually moved higher and this high volume, somebody want to tell me what the difference is on between this period here in August and this volume day to day? Well, blah, it's the low of the year, but you can say that now. Blah, you're pointing out things that you only know now. I want to know what's the difference between this volume today and this volume here as it was happening in real time. Because you guys have the benefit of looking back and being able to say something like that was the low of the year versus the yearly high. Anybody have another guess? Ah, beautiful. DJ. Exactly. Exactly. Okay. It was already downtrending when all of that volume traded. Okay. So, anytime you have high volume like this, you know you have a lot of supply going on. Okay. But after a big downturn like that, you have to question. We have high supply, but we've downtrended, and you saw the price hold right here. So now you have to say, wait a second. We downtrended. We held on huge supply. There's a buyer for every seller. So even though the volume pattern is red representing supply, there's actually a lot of demand here. How do we know that? Because of the total volume and the fact price action had kind of stopped on those 4 days. And most importantly, coming into it, it was after the stock had dropped from 37 down to 28. Compare that to this, where, again, it's after the stock has dropped from 52 to 48. And now, again, we say we have a lot of supply as represented by the volume. So now we have to see, but the difference is, in the short term, it's after the stock has gone from 52 to 48. But in the intermediate term, it's after the stock has gone from 28 to 54. So there's a big difference in terms of price, okay? Remember, price is the only thing that can tell you about supply and demand. Price and volume, okay? It's up to you to then say to yourself, down here at these prices, even though the volume is high, signaling high supply because it's a red volume bar, the price has dropped. So there is actually some good demand here, because you notice that on this huge volume, it actually didn't really go below those lows. Versus now we're up here and the volume has picked up again. And again, we say it's supply volume. But we have to remember all these people who have caught this great run from 28 up to 50 who might not have sold above 50. Just as there technically is demand here today, just like there was demand here on the 8th and the 5th, the perspective of price, because it's already rallied substantially, and because it's just come down from a high versus being at a low, we have to go into the psychological mind state of all of these people from September through April who haven't sold. Price is telling me that there are likely to be more sellers than buyers. And volume is telling me that that started today. So that's the first thing that catches my attention on Home Depot. As for support, it's going to be this March 6th low of 46.12. That's your key support. Below that, you've got the January low around 43. What I will note on a longer term chart, because I've actually been researching Home Depot, thinking about initiating a long-term position, I like this. So what do I like about this right here? It was able to get above its 2004, 2006 highs. Okay? Something the market has been unable to do. Now you can see where it's stalled out is that it's on its way to all-time highs, but the fact it broke above this level here, it put in a higher high from a long-term basis. So from an investment perspective, Home Depot is still very much in play if you're going to invest based on the long-term technicals. I wouldn't be surprised to see a retest of these prior highs in that $42 to $44 range, and I would expect there to be a good amount of support there. But we're traders, so back to the short term. So we talked about those immediate supports from the March 6th low. Then we'll have yesterday's low of 49.72 combined with today's high 47.25. So 47.25 all the way up to 49.75 is going to be key resistance. Let's get the 5-minute chart and see. So all the volume came in at the open for the most part. At this 47.23 low. Oh, so sorry. So what was I just looking at? Oh, okay. I'm sorry. Yesterday's low was 49.72. Today's high was 49.50. Okay? So the high of 49.50 to the low of 49.75 is going to be resistance. Looking at the 5-minute chart in the short term, you can see towards the end of the day it fell below its afternoon lows. So that's a bearish sign going into the close. Needs to get back above these highs around 48.80. Otherwise, if it breaks 48.50, you've got this support at 48.22. Below that, I would expect a retest of today's low. So you can maybe actually lean into Home Depot on the short side. UVXY, one of those ultras ETFs that I say is the devil. So ProShares Ultra means triple leveraged. Also, if there's an X, it typically means triple leveraged. For instance, SPXU is S&P on the short side, triple leveraged. So anyway, why do I hate this? Well, pretty simple. The VIX has rallied from 14 to 22, which I believe is 50%, or a little bit, I'm sorry, it's not 50%, but it's more than 50%. Meanwhile, we have this triple leveraged ETF has gone from $12 up to 18. If it's supposed to be triple leveraged and it's supposed to mirror the VIX by 300%, how come it hasn't gone from $12 to 36? So that's why, or 48 even, I don't even know. My math is all messed up. So that's why I don't like these in general. If you want to play the VIX and you want to get exposed to the upside on volatility, play calls in the VIX. It is much, much easier. You could buy VIX call options expiring in June. Okay. You could buy the 20 strike call options. They were up 70 cents today from $4. So they were up 17.5% today, while the VIX wasn't even up 0.5%, and while this supposed triple leverage instrument wasn't even up 7%. Okay, so if you believe volatility is going higher, then just buy calls in the VIX. It's much, much more accurate in terms of mirroring the actual return. SHLD, so gave up all of its gains from this recent run, which is bearish, but holding these lows, which is, you know, you can put a bullish spin on that. So that's the key. Below 49.75, to be honest, I wouldn't be surprised if it gave up all of its gains for the year. Even at $52, SHLD is still up over 60% on the year. So this level is the one all the shorts are waiting for to fall. If it breaks below this range here at 49.75, this key low, I'd expect much further downside. On the other side, if it breaks above this high of 57.24, people are going to target a move back up to these highs here around 65. Above 65, you then have a target of 70. Okay. So we've got about 20 minutes. I'll do as many questions as I can. So, first of all, in regards to options, this person wants to know what aspects of the stock am I looking at differently. For example, when I trade options on Apple, which is extremely liquid, versus a stock like Salesforce, which isn't that liquid. He's talking in the options markets. Why would you want to trade options on CRM or Amazon? Or what makes you say you don't want to trade them? You know, this person's just trying to gauge my mindset. Well, you need to adjust with the market, okay? So, like, you have a stock like Apple, which just, quite frankly, volume has fallen dramatically, and the ranges have gotten much, much tighter. If you look at Apple in April and February and March, the daily ranges were much wider, okay? If I just close my eyes and mouse and stop, here's a daily range from 606 to 616. That's a $10 range in March, okay? Now, we did finally get a $10 range today, and I actually traded Apple today. But take the range on Apple, you know, these other couple days here, you've got 568 to 575, $8 range. You did have a $13 range here on the 9th. But you compare this to the 578 to 610 range on the 16th. That was $22 range. $32 range. A $40 range here on the 17th. You know, an $18 range. A $19 range. A $24 range. A $20 range. A, you know, $21 range. $11, $13, $18, and you compare that to $12, $10, $10, $7, $13, $13, $12. So the volatility in Apple has really dropped off. And as a trader, we make our money off of volatility, okay? Now, you compare that with a stock like Salesforce. Look how tight the ranges were in Salesforce, while Apple had very wide ranges, okay? You can see Salesforce was in a really tight channel between 150 and 160. Whereas if you look recently now, since May, Salesforce, the daily ranges have gotten much wider ever since it fell below this key support level. So it had been channeling, right? So it had been channeling, but then once it broke below this support, the daily ranges in Salesforce, as you can see, have started to get a lot wider. So Salesforce has been much more volatile. Also, The volume in Salesforce in May has averaged over 3 million shares compared to April where it averaged around 2 million shares. You take that comparison to a stock like Apple, which averaged about 24 to 30 million shares throughout March and April, and now during May it's averaging less than 20 million shares. Liquidity and volatility is going to choose for us where we decide to play, okay? Because the more volatile the range of the stock is, the more volatile the range on the options are, the more opportunities we'll have to go. Stock like Amazon. You can see after being range bound for a very long time, so from 180 to 200 for much of the beginning of the year, it finally broke out. And Amazon is now holding near its most recent highs versus stocks like Apple, which, you know, they're just kind of in slow downtrends. So Amazon is showing us strength where if it can break above 230, we can get some real upside in Amazon. But there's also this wide gap in Amazon where if it breaks below 220, there's no real support until this high here around 210. So it all has to do with the setups. There's no method to the madness as far as just, oh, I'm going to trade Apple today. Oh, I'm going to trade Salesforce. I'm going to trade Amazon. I'm going to trade Chipotle. No, you need to take advantage of the setups. Some setups offer you better setups. It's like one friend calls you to go to the Bulls or the Knicks or the Lakers game, and he says he's got tickets in the 10th row, and you say yes. Then your other friend calls you, and he says he's got courtside tickets. Sorry, bro, I'm going to sit courtside. Don't mean to be a dick, but that's just the way it is. So Salesforce and Amazon have been offering us courtside tickets, while Apple lately, after offering us courtside tickets for about 2 months, Apple now is offering us tickets in the nosebleeds. Now, if Apple breaks below, 550, the floodgates could really open on down to 520 or so, and things could get more exciting again. And as far as the criteria, it's always going to be just volume and price action, support resistance, the things I just talked about. Volume is greater in Salesforce right now. The volatility is better. So, that's where I've been playing. Apple, the volume is lower. We're waiting on key support to really break and for the volume on the supply side to really open up. Number 2, how does your strategy change for summer trading to be successful? Does that mean watching a wider range of stocks and looking for smaller gains? My strategy doesn't change based on the calendar. Simple as that. My strategy, there's only one thing that determines my strategy. That's the market. That's it. Would you mind covering what the different option orders are and how they work? So you've got 4 orders here. You've got buy to open, sell to close, sell to open, buy to close. Okay? Buy to open is, in stock terms, just like buying the stock. Selling to close is just like selling the stock. Selling to open means shorting the stock. Buying to close means covering your short. If you put those all in stock terms, that's what they all mean. So, for instance, we've got VIX here. We could buy to open 3 contracts at, what the heck is going on? Oh, so we could buy to open VIX contracts at $5, okay? And then if that order filled and I wanted to sell it at $5.25, I would just do sell to close, okay? Now, if I think the VIX is going to go lower, what I could do is I could short VIX options, just like I would short a regular stock, and I could say sell to open. So I'm going to short 10 contracts at $5, and if the VIX fell down, if the VIX declined tomorrow, and as a result these call premiums decline, I would then buy to close to cover my short. So that's all that means. If you put it in stock terms, when you see buy and sell and shorting and cover your short, these are what these all mean. Okay. This person's question is in regards to Apple. So this is good because we just talked about it. And he speaks to just what I was speaking about, how the daily ranges have gotten much tighter and it's made it harder to trade because there's not as much volatility. But he notices people have been just playing the channel. And he wants to know, is there a good way to judge when Apple is going to simply channel intraday versus having a big move? Okay. Second, how can I better gauge when Apple is breaking out of its channel versus bouncing off of it and coming back down? Well, the good way to judge these things is the same way we judge everything else. What's the recent history telling us about it? So you take a stock like Apple, and right now the recent history, number one, is telling us it's in a downtrend. That's first and foremost. Number two, it's telling us there's low volume. Okay? And when we have low volume, that means just a slight increase in supply or demand will likely result in the directional move we're looking for. As for Apple having a big move, how can you tell, is it going to move big versus channel for most of the day? You always want to take the low from the opening first few minutes. Okay? So for instance, and then you want to trade it, you want to trade against that range. All right? So for instance, we're looking at a 15-minute chart of the last 4 days on Apple. So here was your low on last Friday, and here was your high. You can see once it broke above this high, it made a nice move from 568 to 573, 574 really. Then on Monday, though, it opened just below that range, so that was your first clue to be bearish. And then later on throughout the day, it broke below that channel, so there's your short signal. And then it stayed below the recent top end of the channel, so that was your, that was your continuation. That was your signal to stay short. Adding more credence to that signal is the fact that volume was very low. We didn't have high volume relative to the volume within those first 15 minutes. Okay? And then today, again, you saw the stock very high volume within the first 15 minutes. Never could quite get above the top end, our low from yesterday, which, okay, so we saw support become resistance, which is textbook for staying short. And then again, once we broke below it on very high volume, confirming the down move. And, we drifted all the way down to 552. I myself, personally, I actually swung traded Apple. I went short yesterday around 562 or so. And I typically, as you guys know, day trade. However, because Apple's ranges have gotten much tighter, and the volatility that makes day trading Apple so successful, I've had to adjust my strategy. As a result, I decided I'm going to swing trade Apple. Why? Because the chart stayed bearish. It gave me no reason to exit my short trade as of yesterday, other than if it would have hit my target and I was taking profits, which it did not, because as people in chat know, I said my target was a breakdown below 555. I got that today. I took profits today. And I still held some, actually, because it still looks like there could be some downside. So another thing with Apple, we do trade Apple a lot because it's very liquid and very volatile. But this is why you have to have a group of stocks that you mix between. I used to trade Priceline a lot, but the last couple days in Priceline, Priceline's ranges have been pretty tight as well. Chipotle's ranges are starting to get bigger though, so I've been watching Chipotle a lot more. JP Morgan, the ranges, they're getting huge with this big drop. I don't really ever trade JP Morgan, but I have recently. Okay, so when the stocks you typically trade fall off in terms of opportunity, you need to have other stocks you can go to and be able to trade. And that's why staying in tune with the market as a whole through stuff like the SPY, QQQ, oil, XLF, XLK, energy, XLY for discretionary. That's why these things are very important, because I don't watch all these individual stocks. But I can tell you just by looking at the weakness on XLY on very high volume that stocks like Macy's and Nordstrom's and Limited, they're probably downtrending. So I can pull up a chart of Macy's right now, look at it tonight, and because I'm in tune with the market, I can devise a plan for a stock like Macy's. And I'd be willing to bet. So here you go. So Macy's is broken below its most recent lows. Looks pretty bad. Limited holding up a lot better. So there's some strength in Limited. Nordstrom's broke below its recent lows. Looks pretty bad. All right. Urban Outfitters, that's another one. So Urban's broken below its recent lows. So by staying in tune with the market as a whole, it'll make it a lot easier to move to different stocks that are offering better opportunities than, say, a stock like Apple is right now. Okay? So this is a good question. I like this point this person raises. He notes how he's been with us since January and he's had a lot of success since his first trade in February, but that recently he's in a horrible slump right now. And the slump is basically that he can't get himself to buy stocks, so he's hesitating. He sees a good stock that looks like it's going to gap based on what he's learned. It does gap, and he's not in it. He sees a stock that looked good to bounce. He knows it's going to bounce, but he hesitates, and by the time he wants to get in, it's already gone. And first month he made 32 trades. Now he's barely making one a week. And he says he hasn't lost a huge amount or anything. He wants to know, is the market being slow? What should he feels like forcing trades possibly. Now, in my opinion, if I put on my straight for a minute, this person had success, okay? And he had success because he wasn't afraid to have success, okay? He took what he learned, he put it all to good use during those February, March months, and he had great success. So much success that now he's, in my opinion, scared to fail. He doesn't want to undo the great success he's had. And this can be a tricky problem where you almost get that perfectionist syndrome where you do so well that it's like every trade becomes a winning streak. Okay? And you can't think like that. You can't fall into that trap. Everything needs to be about one good trade. Because if you just make one good trade each time based on your analysis, based on if you think it's going to gap and you go for it, if you think it's going to bounce and you go for it, you win some, you lose some. But if you're making those one good trades, eventually you'll have a winning streak together and you won't even think about it. Just like he probably had in February when he was, just trading normally. But what happened is he saw the success he had in February, and he probably thought to himself, man, this is a lot of fun. I really like this. And instead of it becoming trying to make one good trade, it became, I have to make one good trade. I have to be successful. I have to keep this going. Okay? Versus, I'm going to put myself in a position to make a successful trade. And if the market rewards my preparation and my execution, I'll end up with some profits. And if it doesn't, because I have a good plan and because I executed thoroughly, I'll just suffer minor losses. So what it sounds like to me is this person is afraid to undo some of the success they've had. And, that's completely normal. Don't force anything. Just look back, and this is why I say print out your trades and review them. Maybe look back and see what was working for you in February and just look yourself in the mirror and you say, you know what? I am a good trader. I need to do this. I need to trade. I'm a good trader. I know what I'm doing. You know, why the hell am I only making one trade a week? Okay? The answer is psychological. It's something going on in this person's head where they have scared themselves out of trading. And the only thing I could assume, because they said they've had success, is they're simply scared of not continuing their success. But as a result of thinking like that, all you're going to do is set yourself up for failure. All right, I'm going to save these next two questions for tomorrow because it has been a little more than an hour and I have some commitments, so I promise I'll get to those tomorrow. All right, everybody, have a good night. You are welcome. And this will be posted by the end of the night, most likely. If not, definitely, well before tomorrow morning pre-market.